So continuing on in our topic discussion on equity method, we're looking at learning objective number 2. So we're looking at the application of the equity method and guidelines. So in our first presentation, we talked about significant influence, and significant influence is guided by FASB ASC topic 323. This is where we kind of define what significant influence is. So basically, our representation. So we are the corporation that has purchased stock in another corporation. And so we definitely want, depending on an ownership percentage, we want representation on the board of directors, because that's where decisions that pertain to the company's direction is going to be pertinent to us. We are also going to be able to influence their policy making processes, therefore gaining an advantage on our own business strategy. So you have to think that maybe we have purchased such a large ownership percentage on this company as an investment conduit, but we also maybe we have other purposes that pertain to our own operation. So for example, if I was a wholesaler, maybe it would be in my best interest to have some sort of saying on the distributor side of things, and so investing on a distributing company would help me on my business strategy. So those are kind of objectives that we may have in purchasing such a big chunk of ownership or shares in another company. And in that regard, we may involve in intra-entity transactions. Intra-entity meaning between the two companies, just again to gain economic advantages. We may interchange personnel, we may use the same accounting systems, etc. So that's what significant influence means. There are certain limitations of the equity method, and as we said before, I think the last sentence kind of summarizes that in this slide, is that regardless of the ownership level, we need to take a look at the level of influence that we're exercising and even control of the other company, because that's what's going to determine the accounting treatment. So just a summary of our different tiers and stock ownership levels. So you can just review that. What's interesting is, let me just get my handy pen here. Oh, I'm sorry. Wrong. Yeah. So we're looking at this accounting method for the different tiers, okay, just like we did on the other slide in our first presentation. So here's just an illustration. Let's say there's a company A with 10 million shares, and we purchased 2 million shares out of the 10. So we now have a 20% ownership in this company. So we are company B. And so if company A were to report a net income of 1 million and dividends of 20,000, so we own 20% of this pie, and therefore 20% of net income and 20% of dividends should be reflected in our financial statements. So these two slides, the increases and decreases on the equity method, the investment account, are summarized in this slide. Basically, you're going to have two accounts that are new to you that we didn't actually look at in intermediate accounting. We have an investment in investee account. This investment in investee account is a balance sheet account, is an asset. We said that at the beginning of our presentation, our last presentation. And the other account that goes with our equity method is the equity in investee income. This is an income statement account. And so looking at our asset, if we recall, debits will increase the asset, credits will decrease it, and therefore our share of the investee income will increase this account. Our share of the investee loss, maybe they didn't have net income, but they had a net loss, then that will decrease this account. And our share of the dividends will decrease this account. There's another, the purchase price, of course, the amount that we pay to obtain this investment will also increase this account. I kind of omitted from this T account, but it would be included here as well. So if you're looking at this, it kind of reflects retained earnings, right? Retained earnings is increased by net income, decreased by net loss, decreased by dividends. And so it's kind of like we are reflecting our share of that company's retained earnings. But of course, for us, it's not retained earnings, it's an asset, okay, because we have invested in this company. And on the equity in investee income, this is reported on the income statement. So a credit would increase this account, a debit would decrease it. And so if our share of the investee net losses will decrease this account, and our share of the investee's income increases it. So we're just going to keep track of these T accounts as we go along the different presentations and see what the effect is of transactions that the two companies engage into.